Joining us from the CME Group is John Bougearel of Structural Logic. He actively trades the dollar and the Russell, S&P, and Dow indexes, so he keeps pretty busy. Also back with us, Jim Paulsen, Chief Investment Strategist at Wells Capital Management, which oversees $342 billion. He says the longer-term outlook for stocks depends on, surprise, surprise, the jobs market. Jim, so let's kick it off with you. Some optimism back in the market today, but again, cut to the chase. It's still all about the labor market going forward.
It is, I think, Carol. I don't know if we could read much into the declines or the advances here in the summer doldrums we call August. It's been very low volume. So I look forward to getting back to fall and here in September and see where we're at. And I do think the only tonic that's out there for the sentiment that exists anymore is going to be jobs. We need about 3 months of 200-plus payroll gains, and then I think we're going to see, a radically different market outcome. There's three things I like. I like the fact there's pessimism. That tells me there's a lot of money on the sidelines waiting for the rainy day that could really drive stocks if it turns out better. I like the valuation metric we have of 13 times earnings with a sub 3% treasury yield and rising profits. That metric looks fine if we're headed for a double dip, but it's going to look kind of silly if we find out we're in a sustainable recovery. And then I think there's a catalyst for better growth coming, Carol. We've had a big drop in yields in recent months, big drop in oil prices, a drop in the dollar, a cessation of the European fears, a quitting of the Chinese policy official tightening. Those forces may combine to help the fourth quarter look a lot better. Ergo, maybe the third quarter in the stock market doing better.
John, you think Jim's right here?
I think I agree with Jim. I think the stock market's going to improve dramatically here. Where I would differ with them is I think you can get by, a stock market can strengthen here without jobs being created.
Without jobs being created?
One of the reasons
Why that?
Yeah. One of the reasons I think that could happen, it's very much like in the 1930s. You had 25% unemployment, but the stock market rallied significantly for 5 years off of the 1932 low. Near term, we've had an diminishing of risks in the sovereign debt defaults out of Europe. We saw the Irish debt auction today go a lot stronger than expected, and industrial production was in the U.S. economy was higher than expected, indicating that you do have evidence of a slow recovery and diminishing sovereign default risks. Those two conditions alone should drive our market significantly higher.
So, John, we've talked a lot about the housing market today because of the happenings in D.C. here, talking about the future of housing finance. I mean, until we get to those key structural problems right now within the economy, housing a big one, and, of course, jobs, it's going to be tough, don't you think, though, for the markets to really take off here?
Well, as far as the stock market is concerned, Carol, I believe that the stock market this is a corporate-led economy, and corporate America can do okay, and it's a bifurcated economy. People are not going to be working, and the housing market is going to be dysfunctional for a great number of years ahead of us. So, but you're able to grow earnings. We've got great earnings out of the stock market, and they did this by slashing and burning their cost cutting, and we're able to get by even in a sluggish economy in corporate America.
But is that sustainable? I mean, Jim, that's the question, right? You can only cut costs so much. By the way, I'll mention Analog Devices out. Third quarter EPS 65 cents. They see 68 to 72 cents. So Analog Devices beating the street by a nickel. Is it really a surprise when we see these companies come out and beat the street's expectations? They cut costs. They guide analysts' expectations. Some people would say they have an ability to move their bottom line into different directions when they want to. I mean, does it really make a difference if home prices are still falling and 10% of the people in the country are unemployed? Jim?
I guess, Matt, I think the earnings have been phenomenal. Even the top line, I think they're up. S&P top line revenues are up 12% in the first quarter. I thought on Bloomberg recently, I saw top line numbers among the 500 companies for the second quarter are 8 to 9%. You got to remember you're living in a 1% core inflation world. So those real growth rates on top line are really pretty phenomenal. They're probably better than when we were doing double digits, but had 3, 4, 5% inflation.
But wait, are they coming from a low base here, Jim? I mean,
I think that's some of it, Carol. I totally agree with that, but it's still real, and it's also plugging into something that Mark Mobius and others have been speaking to, that there's a part of this world that's got a very fast growth rate going on, and we're taking advantage of some of that by plugging into some of the emerging world sales trends. With some of those emerging worlds like China, now the second largest in the world, they're not so emerging anymore, but they still have very rapid growth. I think we do need jobs, and they need to show up, because I agree, if they're not there, it's hard to make a sustainable story. But I think they're on their way. I think there's a lot of indicators saying they're very close to accelerating even further than we've had already.
Hey, John, it's Dominic here. A quick question about this. A lot of people would argue that it's not corporations that lead this economy. In fact, they say 2/3 of our GDP is driven by the consumer out there. And of course, for the consumer, it really is about jobs right now in real estate, right? So how can we get through this if it really is going to be about people finding jobs and getting back to work so they can spend?
Well, I think that's going to be a discussion for 2011. If the jobs do not materialize, the corporate-led recovery right here, right now, they're not going to be sustainable. But right now, the earnings growth rates is what the markets are looking at, and they're saying the earnings yield in the S&P versus the Treasuries are very attractive here, and I think that's going to be a significant driver in the second half of 2010 for the stock market.
But guys, here I'm looking at some headlines from Dillard's, and they're announcing a share repurchase program. They're buying back shares up to $250 million. Again, to me, we know, companies, corporate America has healthy balance sheets. They have a lot of cash on hand, but they're not using that cash to hire workers. They're not thinking about doing that. What they're doing is things like buybacks. I mean, to me, that doesn't show a lot of faith in the outlook here, and spells out some troubles for the economy going forward. I mean, Jim, don't you buy into any of that?
Well, let me throw this out, Carol. To me, this recovery seems very similar to the last two recoveries we've had. The recovery in the early 90s and the recovery in 2001 both started sluggishly. They didn't create any jobs for a year and a half into the recovery. This one's actually created them faster than either one of those, but still very sluggishly. One big characteristic that caused jobs to show up in the previous recoveries was when productivity growth slowed down. In 1990 and 2001 recoveries, we had a big surge in productivity growth, and then it slowed, and that's when jobs showed up. Well, we just had a big surge in productivity in the last year or so, and now it's slowed. They're starting to show signs. That might be the key, that they can no longer do what you're saying, stretch workers further. They're going to have to pony up and actually hire somebody. That could be a good sign.
John, let me ask you about the state of things in Washington. We had Michael Arenstein on yesterday saying that he thinks that the administration or the powers that be there need to start speaking to people who make business decisions and convincing them to hire. Doesn't seem terribly likely to happen. And then you have a slew of columnists saying there's so much uncertainty out there that people won't make a decision, like business leaders won't make decisions like hiring people. Do you have any faith that Washington moves in that direction and helps us along here?
Well, it's going to be difficult because it's really particularly challenging for the small businesses to listen to what Washington has to say in the near term, because their unemployment insurance taxes just went up in 2010 over 27%, and they don't know what's coming in terms of headwinds in 2011. So there's, especially with the midterm elections. So I think they're going to have, I think any expectation that the small business will be listening to what the administration has to say will fall on deaf ears here in the near term. On the other hand, Jim's got some good points about the productivity. A slowdown in productivity has spurred up hiring, and we do have a similar jobless recovery to 2003 to 2004. And we are seeing improvement in the regional surveys, that they're seeing improvements in the employment indexes. So we should be able to see some job growth.
Wasn't it just a week ago that we heard from the Fed, and they kind of brought down their outlook on the economy? It freaked out the markets, not that day, but the following day, and that's really set the tone for last week. I'm just curious. I mean, what are you guys seeing, John, that the Fed's not seeing?
Well, I think what you got with Ben Bernanke is he has an uncertain outlook, and it's unusually uncertain. And I'm quite a bit, I'm taking his unusually uncertain outlook about the economy, and I'm considering it very much like Greenspan's irrational exuberance in December of 1996. The stock market chose to ignore him. And I think that that's what's going to happen with Ben Bernanke. As long as we have signs of a slow recovery, that we got the empirical evidence that that's in place, with the industrial production today, who gave us an indication that that's true. And so did the Irish debt auctions today, gave us an indication of diminishing sovereign risks, at least for the next 5-6 months, Carol.
All right. Carol, hey, John, thanks. Jim, you have 20 seconds.
Okay, I'm just going to say that both the ISM manufacturing and ISM services surveys, those employment components for the first time in this recovery are both above 50% now, saying they're expanding employment. And even the small business survey is at its highest level of this recovery.